Today, we're diving deep into HBL Power Systems. This is a company that has totally reinvented itself, and we're going to unpack the story behind its incredible rise into what you could call a tech industrial powerhouse. Right off the bat, the source report we're breaking down slaps this label on HBL, a compounder play. So what does that actually mean? Well, for investors, that's a signal for a company that's expected to deliver steady, solid, long-term growth. Our job today is to figure out why. Why did HBL earn this title? We're going to look at its strategy, its big shifts, and its financial muscle.
Okay, the absolute first thing you have to get your head around is this. The HBL of today is night and day compared to the company it was just 5 years ago. It has pulled off a massive strategic pivot, really shifting its core from just making traditional industrial stuff to creating high-tech electronics driven by its own brainpower.
And this slide, it just paints the picture perfectly. You can see the shift, right? They're moving away from the old-school capital-heavy battery business and into a much leaner asset-light model. The focus is now on high-margin electronics that are IP-led. That's just a way of saying they're built around their own unique technology and designs. And that, right there, is the fundamental reason the market is looking at this company in a completely new light. So you're probably asking, how on earth did they do it? Well, the main engine behind this change is a powerful competitive advantage, what investors call a moat, in the railway safety market. Let's dig into how HBL built this lead that's, well, almost impossible for others to cross.
This funnel shows you that moat in action. The key here is the Kavach anti-collision system for trains. Now, to even get in the game and bid for contract, you need certification from the RDSO, the Research Designs and Standards Organization. And let me tell you, this isn't some piece of paper you just fill out. No way. We're talking a multi-year gauntlet of deep R&D, tough field trials, and serious technical chops. It basically weeds out almost everyone, leaving you with just 3 or 4 companies that can actually do the job. And in that elite group, HBL is seen as the one with the technical edge. Now, having a great moat is one thing, but what happens when you pour a massive amount of fuel into that moat? That's what we're seeing here. The government is backing this up with huge investment. The railway safety budget hit a record 1.1 lakh crore rupees. This isn't just wishful thinking. This is real policy-driven money that gives a company like HBL a clear, long-term pipeline of orders. And just to give you a sense of the sheer scale we're talking about, the potential market for this Kavach system is massive. Over 40,000 locomotives and more than 60,000 kilometers of track. Think about that. This is not some short-term gig. It's a huge infrastructure overhaul with a project runway that stretches out to 2030 and likely beyond. But here's the thing, and this is really important. The whole story isn't just about railways. Sure, Kavach is the star of the show, but HBL has been very smart about building up other powerful, high-margin businesses to make sure their growth isn't just coming from one place. Let's talk defense. That's a key area of diversification. The company is making a strategic choice to not rely so heavily on domestic orders from public sector undertakings, or PSUs, which can be really cyclical. Instead, as this map shows, they're zeroing in on higher margin exports of their electronic fuses, selling them to places like Europe and the Middle East. That's a double win, better profitability and a less risky business. And this focus on their own tech goes beyond defense. The report points to what it calls a dark horse growth opportunity. These proprietary permanent magnet motors that HBL developed in-house for electric heavy vehicles. This is a totally new line of business, and frankly, it's one the market is only just starting to notice and factor into the company's value. And while they're pushing into all these new areas, they haven't forgotten where they came from. They're not ditching their expertise in energy storage. They're evolving it. They're now making these specialized lithium-ion battery packs. Now, we're not talking about your everyday commodity batteries here. These are high-density, specialized solutions for really critical uses, like in defense and for data centers. It's a really smart way to bring their original business into the future. Okay, great strategy, interesting new products, but what do the financials actually look like? Because all this innovation and growth has to be built on a solid foundation, right? So let's take a look at the numbers. And this is what's truly remarkable. HBL has paid for this entire transformation using its own cash. Just look at this chart. Strong performance and smart management have allowed the company to become basically debt-free. That creates a fortress of a balance sheet and gives them incredible flexibility to operate and grow.
And here is the payoff, plain and simple. Remember that pivot to high-margin IP-led electronics we talked about? Well, this chart shows you exactly what that means for the bottom line. Their EBITDA margins have climbed from the low teens to a really stable and impressive range of 18 to 22%. That puts HBL way ahead of its more traditional industrial competitors. All right, so far it's been a pretty compelling story. But for a complete picture, we absolutely have to look at the other side of the coin. We need to talk about the potential downsides, the risks, the bear case. And the number one risk, highlighted right here, is concentration. A huge chunk of HBL's revenue comes from one single client, Indian Railways. That means they've got a lot of their eggs in one basket. Any policy changes, any budget cuts, any project delays could really hit their quarterly numbers, and hit them hard. There's just not a lot of room for error. So this big risk factor, combined with the fact that the stock has had a major run-up, leads us straight to the key question for anyone looking at the company today. Is the premium price tag, the high valuation, actually justified? Well, the report argues that while a price-to-earnings ratio of 45 looks pretty steep on the surface, it's backed up by the quality of the business. The argument is that you're paying a premium for a top-tier company. You have a return on equity over 25%, which is excellent, and you have really clear visibility into where future growth is going to come from. So, after weighing the powerful bull case against the very real risks of the bear case, where does the source report finally land? What's the verdict? The final verdict brings us right back to where we started. HBL fits the definition of a compounder. What this means is the initial big jump in the stock price from the market re-rating, that phase might be over, but the next phase is expected to be driven by steady, high-quality earnings growth. The report projects an earnings per share growth rate of over 30% a year for the next 3 years. That's a really powerful, consistent performance on the horizon. And we'll leave you with this final quote from the report, because I think it just captures the entire transformation perfectly. HBL is no longer seen as just a battery maker. It's viewed as a proxy for India's high-tech industrialization. Just a fascinating story of strategic reinvention.